All right. Good morning, ladies and gentlemen. This is your host, Tony from MacroRace and also from FinancialJuice. Hopefully, you can all see the video and hear me clearly as well. Apologies, there's a bit of a technical issue with getting the stream up and running. But thank you very much for joining me. Don't forget, this is a free live stream video. You don't have to sign up to it. Don't forget to share it with your fellow traders and friends. But let's get into the US CPI. We've got quite a bit to cover of the expectations and what to look out for from market reactions and what to kind of expect as well. So US CPI, what is CPI? If you don't know what it is already. So it measures how much consumers are paying for retail goods and services within the economy. Okay. So you have 26,000 retail outlets and 4,000 housing units in 87 urban areas, where prices are collected on 80,000 different goods and services. Now, of course, so that means the government will send out their agents to go to these different areas, various shops and businesses, to just look at the prices and then try and measure the change between the last month that they've seen. And then if they might guesstimate some of the price changes here and there. But more or less, it's pretty accurate with the data, the amount of data and how it's collected with the US CPI data. Then the key measurements that make up the CPI report. So housing represents about 42%, food and beverages 14%, transportation about 18%, medical care 8.5%, and then of course you have the core CPI, which excludes food and energy. Remember, food and energy have been the most volatile parts of the reports in the past year, or in the past year or so. Of course, the effects of the Russia-Ukraine conflict having an effect on energy prices and also food prices as well. There's also been a damaging effect from the Ukraine-Russia conflict on the consumer price data. Then the reason why we're looking at the month-to-month data, or usually the month-to-month data, is seen as the preferred data because that shows what's going on in the economy without the effects of weather, production cycles, and etc. So that's what the government focuses on and what a lot of traders keep an eye on for, particularly, and also central bankers as well. We've heard from Fed's Bostic in the past, keeping an eye on the month-to-month change for inflation for CPI and also PC price index as well. So it is quite important to keep an eye on the month-to-month. But in this environment where all bits of data of the CPI report are very important, you can't just look at one piece of the report. Got to look at everything. Then if we're looking at the difference between PC price index and the CPI, so I've talked about this when I did the consumer spending report. But the PC price index basically measures the same things, but puts a lower weight on price of gasoline and residential rents and focuses on the nation as a whole rather than just focusing on urban areas, which the CPI report does. So that's why the Federal Reserve prefers to look at the PC price index as a better gauge of where inflation is at the moment within the economy compared to the CPI. But it doesn't mean that they put the CPI off completely altogether. And we've seen in the past when we had higher than expected CPI figures back in July, if I just remember off the top of my head. And then the markets priced in a 75 basis point hike from the Federal Reserve, going from 50, and then they went for a 75 basis point hike because of the fears of inflation becoming de-anchored or becoming out of control. So again, it's both reports are important, and they depending on where we are within the economic cycle or on the rate hiking or rate cycle as well with the Federal Reserve, then depends on what you focus on. But everyone in now is focused on both bits of data because inflation is too scary for the markets. All right, the previous report. So the last month we had representing the August data. Increases in the shelter, food, and medical care indexes were the largest of many contributors to the broad-based monthly all items increase. The energy index increased 23.8% for the 12 months ending August, a smaller increase than the 32.9% increase for the period ending in July. And the food index increased 11.4% over the last year, the largest 12-month increase since the period ending May 1979. Now, this is the key thing. So we've gone from energy being the clear part of the report that outweighs everything else and sees a huge surge. And now we're seeing that food prices have taken over, and as we're seeing a huge surge in food prices instead. So if you're saying, if in your head you're thinking, well, when is inflation going to peak, or how fast is it going to decline? If you have if you're just solely looking at the data that does, if you're not looking at the core data of where inflation is, and that's what the Fed has reacted to in the past, then it's going to be a bit more difficult to say that inflation is going to get to the Fed's 2% goal, relatively soon. You're probably going to be seeing a mix. You're probably going to see a mix of reports in the future where we see CPI go down, then up, down, and up, and up, and up, or down, until we finally get a bit of closure where both the food price index and the energy index are heading down. And then the core bits of data too, where services and retail goods, or those prices also start to head down. But we're not seeing that yet. It's kind of quite choppy at the moment. Hello, everybody. I've just turned to the comment screen and I see a lot of comments. Hello, Lo-Fi Lili. I hope I said that right. Master Roy says, good morning, everyone. Lo-Fi Lili says, I love you, Tony. The pit trader, Tony with the Tommy killing at all the markets. Audio's good. Real Lady says, hi, Tony. Hey, good to see you again. Yeah, good to, and yeah, definitely leave a like and a thumbs up. And you, hey, James. I see you, James. From Unusual Activity. Like, hey. All right. Okay, so let's get back into it then. As I said, we've got a little bit more to cover. So how does it affect the markets? Now, the dollar will usually strengthen if the CPI report is higher than expected. In this environment, that usually happens when, if it is higher than expected, then the Federal Reserve is more likely to continue raising interest rates, and also they might go, by a bigger rate hike amount in the future. For stocks, so underlying inflation or the core CPI data is really important as well, other than all the other bits of data with the headline in prints. But if the core CPI data starts to rise sharply within the month, it can lead to stocks taking a bigger hit as well. So if you see all the CPI bits of data seeing a sharp rise or rise, then you see a bigger slump in the stock market. And then for bonds, if we're keeping an eye on bond yields, or for bond yields, they usually head higher if inflation is higher as well. Of course, it means that the Federal Reserve is going to continue tightening monetary policy, might go for a bigger rate hike amount in the future. So bond traders start to, the yield that starts to rise as well. Now, the bond prices will, of course, move in the opposite direction. So bond prices would head lower in anticipation of higher yields with higher rates of interest rates in the future from the central bank. Then where is the economy at the moment? So last month's, then these indicators are quite important to kind of show you where inflation is at the moment. Non-farm payrolls are kind of used for everything, right? That's the big dog release. But non-farm payrolls was at 263k versus the prior of 315. The unemployment rate ticked lower again to 3.5% versus 3.7%. Average earnings year on year, right? Or what the Federal Reserve kind of keeps an eye on for wage price inflation, or a potential wage price spiral. 5% versus 5.2%. Employment costs for the quarter, 1.3% versus 1.4%. PC price index year on year at 6.2 versus 6.3. Core PC price index 4.9 versus 4.6. And the ISM manufacturing prices paid, or how much manufacturers are paying for the goods that they're creating, at 51.7 versus 52.5, so lower than the prior month. Productivity also revised at minus 4.1% versus minus 4.6%. Import prices were slightly better in the last report that we had, -1%, and the export prices were slightly better as well, -1.6%. PPI year on year was at 8.7%. Excuse me. Excuse me. Yeah, so that's PPI year on year was at 8.5% versus a prior of 8.7%. We had that data yesterday with the PPI, and that sent the S&P 500 going down because it was higher than expected, and sent the dollar flying as well. So again, inflationary pressures are a key point within the environment, current environment that we are in the moment, with the Federal Reserve looking to raise interest rates. And then if we carry on as well, so then what else do we have? So then the triggers then for the economic release. What are the investment banks looking at? What are the median forecasts from the investment banks? So the triggers that they have, right? So the month-to-month, the highest estimate that they see, or the highest figure that they see, is the data for the month-to-month coming in at spot 4% or 0.2 deviation, with a low of -0.1%. Okay. The year on year, they see the highest estimate at 8.3%, with a low of 7.9%. The core month to month at spot 6% versus the lowest figure that they expect of 0.3%. And then the core year on year with the highest estimate of 6.7%, with a low estimate of 6.4%. Then the sentiment at the moment. So there's quite a bit going on. Now, since the last CPI report that we've had, of course, we've got our earnings this week with the investment banks, and then of course we have everyone else following the following week after that. So there's going to be some earnings volatility that is going to kind of creep through, and I think with the bank stocks that we have this week, that could kind of shift the momentum of how the markets react throughout the day. If we get a worse than expected earnings report overall, then you could see that the continuation of movement towards the downside of the markets. But if you do get a good reports coming through, then it could boost the S&P 500 and stocks as well and their valuations. But a mixed report is going to cause havoc. You're going to see mixed market reactions. So earnings volatility is one thing to be aware of that traders are waiting for. The other thing as well is that the Japanese, okay, so the Japanese, they of course had jumped into the markets and had bought up the yen when it hit 145.90, right, on the dollar yen. And then that, of course, had seen the Japanese yen strengthen. So that FX intervention that the Japanese had not only effect on on the currency pair itself, but also for other economic releases that have come through in the past. Now, the reason why I say this is when we look at the deviations for other economic releases, the dollar yen used to have the strongest reaction in the past for CPI, non-farm payrolls, consumer spending. But now that's flipped and switched. It's become, you see more of a whipsaw reaction, an unclear direction, or not a very strong reaction from the dollar yen compared to the other currencies that we've seen, like cable as well. But so that's one other thing to be aware of. Number 3 is we have the UK talking about maybe making a potential U-turn on their tax cuts, which was reported by the Sun earlier today. That could have an effect on, of course, that has had an effect on cable, where we've seen sterling strengthen and move back towards the upside. So there's also that in hand that's at play. That's also affecting sentiment to what the UK is doing with the government, and also the Bank of England, right? The Bank of England say that pension funds have 3 days, or now it's 1 day, to sort out their liquidity issues that they have, right, with all the assets that they have under them. The Bank of England has been buying up some of the, buying into the gilt market, but the Bank of England is saying, we're only going to go so far to help you guys out. You've got 1 day to do, you've got 3 days to do this. Now there's 1 day left. So the pound off of that has seen a huge decline as well, from what Bank of England's Governor Bailey said at an event where he wasn't really expected to talk about a lot about monetary policy. So he just decided to kind of surprise the markets and traders who were looking for the Bank of England to extend the help in the gilt market to the end of the month. But then he said, well, no, I'm sticking to my guns. So sayonara. So that's what happened. So yeah, we have three business sentiment to be aware of in the markets at the moment. Yeah, it's gonna be quite fun. But Goldman Sachs and Morgan Stanley strategists warned that the reporting season would be difficult due to risks such as slowing demand and rising costs. There's also that as well. All right. So Fed and New York Fed survey and other views as well. So New York Fed survey that we had this week, year ahead inflation is expected to be 5.4% in September compared to 5.7% in August. September 5-year ahead inflation expectations at 2.2% versus 2% in August. You had Fed's Kashkari saying that a strong dollar is making US inflation a little less pricey or a little less costly, so a bit more, a bit easier to kind of bear. Fed's Mester said that we need to do more because inflation has not slowed. IMF chief economist Grinchas, who made comments yesterday saying that the fight against inflation by central banks will last until 2024. So the idea of anyone trying to price in or look for any of the central banks to go for a rate cut in 2023, a lot of the expectations of where inflation is expected to be, if it's not expected to kind of die down by 2025, right? From the summary of economic projections that we had with the FOMC meeting, then although they have got it wrong in the past, it's with inflation expectations, it's still kind of maybe jumping the gun a bit too fast, as to say 2023 is going to be when the Federal Reserve decides to cut interest rates, maybe by the end of 2023, but we need to kind of wait for the data to kind of lead us to show us when the Fed might decide to cut rates. So the Federal Reserve is kind of just waiting on data, right? And so are traders too. The only thing we can do is kind of just try to price in as best as we can with what we're expected to see in the future. And that's why these economic releases see a lot of volatility, right? The inflation report, non-farm payrolls, the consumer spending report, which comes along with PCE price index data, that causes a lot of volatility because nobody has a clear direction of where inflation is, going to be going, whether it's going to continue to go up, or, if it's going to chop and change, or if there is going to have one direction. So that's why it's important to look at the CPI report today, of course. And here we go. So also from the summary of economic projections indicated no rate decreases until 2024. And at least one additional 75 base point rate hike in 2022. So we have 2 meetings left in November and December. Now, if we get 75 in November, then a lot of what we had Powell saying that one policymaker was looking at 125 basis points in total by the end of the year of rate hikes. So it probably would have been, could have been Bullard looking for 275s, one in November, one in December. Or we had what some policymakers were looking at 100 basis point hikes in total by the end of the year. So 75 and then a 25 basis point hike. But 25 basis point hike doesn't really make sense. That's a big move. So the question is, do they go for 250s in the last 2 remaining meetings of the year, or do they do or did they kind of switch it up and do go for a 75 and then a 50 in the last meeting, and then kind of do 50s and slowly edge down to a 25? So that is, and then kind of hold for the rest of the year. So that's what kind of makes it difficult again to see, whether or not, other than the one additional rate hike of 75 basis points expected before the end of the year. Then we go. So Fed's Powell. So Fed's Powell on the 21st. So this is after the FMC meeting that we had with the rate. Powell said we are currently figuring out what level we need to reach. never a good sign, huh? You never want to overreact to a single data point. So again, as said, median policymaker sees 125 basis point hikes by the end of the year. Restoring price stability while achieving a soft landing is difficult, and commodity prices appear to have peaked. So again, the shift from commodity prices to food prices now in the CPI report is what Fed's Powell has taken note of there. But the key point, they're unsure of what level they need to reach. So you could have, maybe, I think Ray Dalio said the Federal Reserve could reach 6%. I'm probably wrong with that quote, but if that's what I think, that's what I remember. As Ray Dalio had said in the past. If you're not familiar with Ray Dalio, he's a great economist, gives you a great, if you're unsure of how the economic machine works, he's got a great 30-minute video that simplifies everything for you. But yes, that's what Fed's Powell said here from his September 21st comments. We haven't really heard from him talking about monetary policy since then. So that's what we can only kind of go off of. Other views as well. So you had Sean Cruiser from TD Ameritrade saying that right now the market is attempting to digest all of this data coming in and then place it alongside some sort of rate hike path. So that's according to the head trading strategist. So what I've been saying, right? Everyone's relying on the data. You can't really forecast so clearly where the Fed funds rate might be. It's going to chop and change quite a bit. Some will say 5%. Some will say 6%. Someone will say 10% with the Fed funds rate where it needs to be. But again, there's a bit of confusion in the markets, and when there's confusion and extra volatility, like the VIX yesterday, we were about 34 yesterday. So presumably we're still going to have that extra volatility today. When there is that confusion in the markets and uncertainty, that's when you see bigger moves occurring, usually within the markets, right? Because it's out of fear, really, of what to kind of expect. So whenever you've had a tumultuous week of economic data and the markets have been hammered, and then the following week you see the markets kind of reverse and recover a little bit, take a little bit of a breather. That's because of the uncertainty that we've seen within the markets. But let's carry on. I feel like I've still got a load to go through, which I do. So September 13th, right? So this is market pricing from the CME Fed Watch tool and how it's kind of evolved over time. So from the last CPI report, interest rate futures saw a 35% chance of a 100 basis point hike. Then the September 21st meeting, when there was a confirmation that they would want to see, members would want to see at least 175 basis point hike in 2022. You'd seen 8 to 9% of traders pricing in the chance of a Fed raising rates by 75 basis points at the November meeting. And then October 7th, with the non-farm payrolls, again, with that data that come in, traders were expecting or pricing in a 92% chance of a 75 basis point hike. So remember, non-farm payrolls was, there wasn't much of a deviation from the forecast. It was better than expected. The unemployment rate also ticked down again by 0.2%. So that, usually that's very small deviations, but it was the unemployment rate that kind of sent everyone into a frenzy again. And you'd seen that big reaction from the markets. But there we go. So up from 85.5% to 92%. Okay, so a lot of it now. I think at the moment on the CME Fed Watch tool, we're about at 83%. Let me just do a double check for you guys. 83% in favor of a 75 basis point hike at the November meeting. Okay, it's about 88%. 88.8% to be precise, in favor of 75 basis point hike at the November meeting, and 11.2% for a 50 basis point hike. So anyways, carrying on. So investment bank views, Citi see year on year at 8.1%, as do JP Morgan, Goldman Sachs, and Bank of America. Month-on-month estimate Citi and Bank of America see spot 2%. JP Morgan see spot 3%. If we look at the previous release too as well, let's make that big screen. Okay, so about 10 seconds before the report. This is the previous release that we are watching here at the moment. Got about 5 minutes left on the release itself anyway, when we get back. Okay, so there we go. All the bits of data were much higher than expected, right? And so if this is the big reaction that you'd seen here, where the markets or the stocks sold off, gold died, bond prices died as well, and yields flew to the upside, as did the dollar here as well. So you can see how big of and you can see overall the deviation is not that much. It's point. If I bring up the deviations here for you, it's 0.2%, right? 0.2% on everything, other than the core month to month, which had a 0.3% deviation towards the upside. So if we're expecting a market reaction, a big market reaction like this, you'd want all the bits of data to be higher than expected, right? With at least a 0.2 deviation, to see this sort of reaction from the S&P falling down, declining dollar, seeing a big rise as well. Now, the dollar yen is going to be a bit more of a tricky one, because I think we're not going to get so much reaction to the dollar yen as we have done in the past, because of how non-farm payrolls and US consumer spending report have reacted in the past, where they haven't seen a big, huge initial reaction. It's kind of been very muted because of probably the Japanese FX intervention in the markets as a possible point of reason as to why that happened. So if I just escape this here, let's have a look at the deviations. I'll show you what we got. So, like I said before in the past, if we're 0.2 deviation at least either way, on the data, we'd see a big reaction. But if we do get a bit of a mixed bag of data, where inflation is kind of stalling, that could play into the hand of the stock index, the stocks, right, in the stock market. Because if you get some data that is lower than expected, areas where inflation is ticking lower, that could be good for the stock market, thinking that the Federal Reserve doesn't need to be too aggressive for, in their hiking path, or maybe doesn't need to go for, another 75 base point hike this year. They could go for a 50 instead. But again, so a mixed bag of data is going to cause you extra amount of volatility. It's going to be more of a mixed reaction, or you could see the stock indexes seeing a move towards the upside. So there we go. So this is April 12th, going back there, you'd seen the S&P 500 at the NASDAQ move towards the upside for the mixed bag of data. If it's in line with expectation, again, I think you might see a similar scenario to that there. There we go. So when all the data was lower than expected, you've seen a huge reaction from the stock market. Now, dollar yen, as I said, we've got 1 minute left actually. 1 minute. Let's bring up Tickstrike. Okay, less than a minute. So 0.2% either way. If we get a mixed market reaction, a mixed bit of data, could see a bit more of a mixed market reaction from the markets. All right, here we go. 25 seconds left. There we go. Can see everything. Nice. Whew. All right, 10 seconds. See what we got. Zero spot 4%, 0.4% higher than the forecast of spot 2%. CPI year on year 8.2%, 8.2% higher than the forecast of 8.1%. Core CPI year on year 6.6%, 6.6% higher than the forecast of 6.5%. Core CPI month on month 0.6%, 0.6% higher than the forecast of 0.4%. All right. Okay, so initial jobs claims, nada. There we go. All right, so general dollar strengthening there. I am now a little bit surprised. So the dollar yen didn't really, the last couple of big releases that we had from the US didn't really see a nice clear reaction like we have done today here. What the heck, You're not gonna Japanese, probably because they don't need to. Probably kind of given up with intervening, or they don't need to do too much. Don't want to do too much intervening. So there we go. Also, the other point here is that you have a couple of the prints that are smaller than their previous figures, but higher than expected. The CPI year on year, okay, and the core month to month came in. If you're comparing it to the previous, there was no change. But the forecast, expecting a decline, didn't happen. That's what we had here. Now, what I was going to say is with the deviations right here, Tickstrike's doing his thing. Now, what I was going to say with deviations is that the dollar yen had seen the biggest reaction in the past beforehand. But because of how the Japanese have been, it might be prudent to kind of look at some other currency pairs too, like cable, which has had a lot of volatility so far, which may have seen we'll check today, but that could have seen the biggest reaction today, maybe, compared to what we've seen in the past with the dollar yen. But let me go back. Let's have a little check, shall we? Right, dollar yen. Let's see what we did. Now, okay, that's 47.3 pips. Ignore it if it's like 473. Just in your head, it's just put a dot after the second number. There we go. 47.3 pips to the upside. I want to see what cable did. I correct in saying you might have seen the biggest reaction here. Could have seen the biggest reaction. I don't think so. Oh no. 75 pip move towards the downside. Let's look at the euro dollar, because that was the third largest mover. What we got? Yowie wowie. Okay, wow. 86 pip move. Okay. To be the biggest mover so far. All right. What else we got? Let's look at the S&P 500. Fed swaps fully priced 75 basis point rate hike in November. Short-term interest rate futures traders in the US believe the Federal Reserve will raise interest rates more sharply as inflation rises. Could that be a 100 basis point hike? Maybe. I'm not putting that off. I'm not putting anything off. Like what the Bank of Canada did. They surprised the markets and went for 100 when traders were expecting 75, and they said they underestimated inflation. That's 363 ticks there. Let's look at the NQ. It usually has a lovely big reaction. So if I'm comparing it to the last report, holy schmoly, whoa. Somebody has just crippled it. 1,480 ticks there. Let's look at the Dow. For making weird sounds, apologies. I'm just a little bit. It's always with the CPI report. So I love seeing how the markets react to the data. And 577 ticks. So if we're comparing it to the last report, looking at the YM, looking at the Dow, the last report we had is 664 tick a movement towards the downside. Today we got 577. So a bit of a smaller reaction on the Dow compared to what we've seen before. The NQ has seen a bigger reaction compared to what we've seen last time. Last time we had 1,172 ticks towards the downside. Today we got 1,480. And the S&P 500, a slightly smaller reaction, very slightly, with 363 compared to 369 ticks down in the last report that we had seen. Let's look at gold too. Gold is going to be, gold is obviously going to go down. Right. I should have looked at the bond price first. So that was the initial reaction. So about 228 ticks. Bond prices. What's that? 56 on the 2-year bond prices. There on the bond futures there. All right. Now, if you have liked this video so far, then don't forget to like the video, share it, subscribe to the channel. And if you're kind of wondering, well, where the heck how the heck do I get my hands on this data here that you've got on your screen here, this the deviations and how the markets are going to react to releases, or could react to releases, and I can kind of make my own trading strategy around it. Well, what we can do is you can sign up to the MacroRace mailing list, right? So let me just kind of clarify what you're looking at here, right? What is all of this better data? So this is a list and a sheet of how the markets have reacted to economic releases and by how much. So it shows you the deviation between the forecast and the actual figure, and then going through the different instruments here, the different asset classes, and seeing how much they reacted within the market, compared to how big the deviation was and what the release is as well. So of course you can see here, there's like a good history of how the markets have reacted to the CPI report. Okay, remember we only started this year, so we've got quite a bit of data that we have already anyway, of like the current sentiment of how the markets have been reacting. So not only did we have the CPI report, but if I go back, I'll show you the non-farm payrolls. There you go, that's the non-farm payrolls report there. You've got the deviations there too. Now, the way this kind of works, right? What I do for the MacroRace mailing list subscribers is not only do I provide the deviations for the upcoming economic releases that I'll be covering for that week, but I also provide a summary of the week ahead, or an expectation for the week ahead of what to kind of expect in the different sessions. So the Asia session, the Europe session, the US session, and then also the summary of the weekend news and the releases that we'll be covering here. So this is kind of short and simple, but it's enough information to kind of give you an understanding of what to kind of expect for the week ahead. So alongside with the deviations that you can see here as well. So there's that. So it's quite simple. Something that's put out every Sunday in one email that I do with the week ahead expectation, the deviations for the upcoming economic releases, and the live stream links of the YouTube videos that I'll be doing for the following week as well. Now, if you want to subscribe to the mailing list, then here it is. That is the link there. There we go. So there we go. So MacroRace, that's the link there they can subscribe to. And then also FinancialJuice Pro, right? So where we got the data from, I just minimize that. Here we go. So the FinancialJuice website. Now, you can see that the data appeared here, and in real time, you had seen the markets reacting to it in a big way as well. So this live real-time voice and text service that we have is basically what investment banks use as well. They have their own live voice and text service that they use to manage their risk and to capitalize on potential trades. So if they have access to that, that's quite high level. So this is what we want to do for you guys, right? To be able to listen into this, to the voice live, on listen into the economic release live as well. See the headlines come in real time as well. You also see the the economic releases here that we have on our FJ calendar in real time as well. And so what we want to do is provide you with a 7-day free trial of FinancialJuice Pro as well. To have a little play with it here. There we go. That is in the chat. I'm going to pin that message to the top so you can continuously see it. But that's the video. Excuse me. That's the link there for you. Now remember, if you're on the live version of FinancialJuice at the moment, you're getting adverts. You're getting a 10-second wide delay on the website as a whole. So if you go FinancialJuice Pro, remember time is money, and being quite quick with is it's very important. So if you can, the quicker you can capitalize on a potential trade or manage your risk, the better. Hopefully the better your experience will be with trading. Of course, if you're new to live voice and text service, have a little play with the 7-day free trial. Don't jump into a paid membership straight away if you don't know how to use it or you're unsure of what it is. And go through the sign up for the free version, the live version, and then when you're ready, right, then jump onto the the paid version of FinancialJuice Pro, right? So you've got the link there to join us and jump onto the link. But also, again, if you're new to it, take your time with it, right? No rush. Don't want you to make a mistake or not understand or get frustrated. That doesn't help anyone. Right, so that's the link there. Now, Tickstrike, what you've also been seeing as well. Now, if I just bring it back up again. Workspace. Let's go. Let's releases. We go. Okay, so here's Tickstrike. So if you're unfamiliar with what Tickstrike is, so Tickstrike basically allows you to listen to the order flow that is pumping through the markets. Okay, so in simple way, it lets you listen into the strength of the momentum, either in the buy direction or the sell direction of a certain asset or instruments that you want to look at, how strong the reaction is. So Tickstrike here, right? So we currently got, so not only do we look at Forex, crypto, we also look at futures, stocks, ETFs and ETNs. You also have the internals as well that we look at. But to understand what Tickstrike is, if you're new to it altogether. So now this window here, you might be thinking, well, what's this -1 and +1 here? So a minus figure shows that there is selling momentum going on, and then vice versa for the plus figure. If you see, when you have, if we're on level 1 here on this slidey thing here, whenever there's a little bit of buying or selling that's going on, then Tickstrike will alert you to it visually and audibly. Okay, I've currently got the audio turned off, otherwise you guys will get annoyed with hearing Tickstrike going off a bit too much, and whilst I'm talking, trying to present to you. So you've got here, so when there's a little bit of buying or selling that's going on, Tickstrike will go off, and when there's a bit of momentum. When you want to see a lot of momentum within the market, or of buying or selling, and you don't want to hear these little tickers going off, then you can increase that. Then you can increase the number to level 15. Level 15 is the highest level that we have, and that's the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum within the stock or the currency pair or currencies, whatever you're looking at, only then will Tickstrike go off and alert you to the move. So here you can see that it's not really going off compared to in other currency pairs too, where they might be going off here. Okay, so you can kind of chop and change and play with that too. What kind of level of sensitivity works for you. And that's why I want to give you guys a 7-day free trial of tickstrike.com. Have a little play with that. Again, a lot of traders, if you're scalping, if you're day trading, it's perfect, right? You can, of course, a lot of traders, have talked about, managing their trades if they see a lot of buying that's coming along if they've had a position to sell. Again, and also to capitalize on potential trades that appear to on the momentum that they see. That's that's just somehow how some of our customers have used it in the past. Doesn't mean you need to use it in the same way. Figure out what works for you, right? So have a little play with it. You've got the 7-day free trial there of Tickstrike. Play with it and see what kind of works for you. Whatever makes sense. So that's Tickstrike there for you. And then finally, the final couple of little things. So if you like trading unusual volume activity in stocks, right, you can join the free beta test group of our new service of unusual activity. So I'll put that link here as well. Whoops. All right, there we go. That's the link there as well. And then also don't forget to finally follow us on Twitter. So Twitter at MacroRace _. There we go. Woo! All right, that is it, ladies and gentlemen. That's it for the week as well. Take care. Don't forget to sign up to that mailing list if you want to see the deviations for the upcoming economic releases that we'll be getting in the future. Markets are still dying here. Gold and bond prices are taking a heavy hit. So is gold, that's still not recovered. Cable still down. Euro dollar still down. Dollar yen still down as well. Let's see. Yeah, kind of looks about the same. Not really moving that much now. Okay. All right. Thank you very much. Thank you for the comments that you've given me here. Sadhu Kitar says, will it continue down or what? Who knows? Well, after 10 minutes, I'd show you the deviations after 10 minutes, right? You know what? To be fair, I'll bring it up here for you. So this is after 10 minutes of trading. They usually kind of take note of where we kind of end up. Okay. Right, so about 407 ticks down after about 10 minutes of trading. Well, all I can say to Duquette is good luck. Enjoy the trading. All right. Real Idiot says best for your pension. Tony, thanks. Stay safe. Trappist says thanks a lot, Tony. All right. Len Ulan says, do you get limited Tickstrike with FinancialJuice Pro? So whether you're on Lite or Pro, it's limited. You need to sign up for the full version to access all these other tickers that we have: forex, crypto, futures, stocks, ETFs, and ETNs, and internals. You need to sign up to the full version there. Sarek says, would you have to DM me? You have my email to have. But yes, I can DM. But you've got my email. Have you not? Anyway, I'll send over my email if you have any other further questions. Then you can do that there. All right, sign out, everyone, and take care.